how to compare the value of life insurance policy illustrations. There are so many products and so many companies that it can become confusing how to compare one product to the next, even within inside one company. So where do you start? What purpose is behind the purchase of your policy? Are you purchasing it primarily to build cash value? Are you purchasing it to create a death benefit? Are you purchasing it to have early cash values so you can leverage those cash values and use that capital someplace else? How long are you planning on paying the premiums? Some people want to pay it 10 years, some people 15, 20. Maybe they want to have it paid up by the time you're 65 or 85. All of those can affect the values in your policy. So you need to have that in mind and compare similar products to similar products. How long will you own the policy? Are you really planning to own this policy till death? Or are you going to use the cash values and later on let it lapse, or maybe even sell it as a life settlement? Will you be using the policy as collateral like we talked about earlier? Are you planning to use the cash values to leverage and be able to invest someplace else with that money? And finally, what is the most probable time will the death benefit be needed? Those are all things that need to be considered if you're going to do an apples-to-apples comparison in life insurance products. And here's the question. Do you really want to keep more of your money? Evaluate the difference between the total premiums paid and the total guaranteed cash values is the best way to find out what you're really paying for the life insurance. Without completing this comparative evaluation, you won't know if you will be able to keep more of your money, or you'll end up paying more money for your death benefit over time and your cash values. Finally, what are guaranteed values? They're the only thing that's protected by the life insurance contract that you have. So don't become distracted at this point by non-guaranteed values, because they are not protected by your contract until they're paid. And the uncertainty of when they will be paid or if they will be paid remains unknown. That's why they are non-guaranteed. So let's figure out what the guaranteed values are. You won't really know until you compare the total premiums paid to the guaranteed values accumulated. Recently, we had the opportunity to compare 4 different policies, illustrations from 3 different companies. And it's very fascinating. The first 2 policies were from the same company. And look at the difference between premiums paid and cash values by age 85. The first policy, same company, as the second policy, had, 3.5% less values in cash values than they had paid in premiums by 85. Policy 3 was from a different company. It had 36% more guaranteed cash values than the premiums paid by age 85. And the fourth policy was from a completely different company, and it only had 7.1% more guaranteed values. Remember, guaranteed values are the only thing that is guaranteed by your insurance contract. Percent difference between what has been paid in premiums and what the guaranteed cash values are provides you with a percentage, and that percentage then can be equivalently compared with other policies once you've figured out that percent difference. So make sure that you do this so that you realize which policy is actually giving you more guarantee than another policy. Now let's put some cautions up there concerning non-guaranteed values, because many people like to focus on the non-guaranteed values, and there is a purpose for non-guaranteed values. Non-guaranteed values are very important when we're using them to evaluate the difference between a life insurance return and an investment return, because they're both a speculation about what future returns might look like. Non-guaranteed values are projected differently by different companies because there is no industry standard regulating how these policies are projected. I have seen them projected differently from one type of policy to a different type of policy in the same company. So be very careful that you're not comparing non-guaranteed values against each other, because there is no standardization on how they are to be reported. For example, not all companies illustrate their non-guaranteed values after they've deducted mortality and expenses the company is projected to experience. That's going to skew the numbers in their favor. This leads to large discrepancies between a company's projected returns and their actual returns, and can be very disappointing for people that were setting their sights on those non-guaranteed values. But more important than that, it nullifies any results derived when comparing the non-guaranteed values of one company against another, because there is no standardization there, and there is no way then to arrive at an apples-to-apples comparison without knowing that proprietary information. Finally, know the cost associated with your policy loans. This can dramatically change which company you may want to put your premiums with. If you're paying 8% for a loan versus 4% for a loan, that can make a huge difference over time. Understand how interest on policy loans could alter your policy cash values. Realize that borrowing against your policy and paying the loan back is not what increases your cash values. Only the purchase of paid-up insurance is what increases your cash values in a life insurance policy. The non-guaranteed side, dividends can be used to purchase paid-up insurance. You can use a paid-up additions rider to increase the amount of paid-up insurance you can buy. There's all different ways on how to increase the paid-up insurance value in a policy, which is then in turn going to increase your cash values. Don't fall for the misguided advice which advocates not to pay policy loan interest, because policy loan interest will not be covered by non-guaranteed returns in a policy, especially in this era of low interest environments. So be very, very cautious about that. And finally, discover how to become a better money manager. That's what's key. That will be what allows you to keep more of your money and will allow you to experience how to keep most of the interest you are currently losing when you pay cash or use credit to purchase anything. Hopefully this has been helpful in you in deciding the values that you can look at to compare one policy to another as you're either preparing to buy an additional policy or buying your very first one.
Hey guys, thanks for watching this video. If you enjoyed it, please give it a thumbs up. Also click the subscribe button to enjoy the latest content and newest videos on the channel.